Welcome to our deep dive into the stock market downturn of 2002. In this video, we will explore the key events, analyze the data, and extract invaluable lessons from this critical period in financial history. Let's get started. The stock market downturn of 2002, often referred to as the dot-com bust, was a major market decline that followed the explosive growth of the internet sector in the late 1990s. The peak of the dot-com bubble was in March 2000, and over the next 2 years, the market saw significant losses. To understand the extent of this downturn, let's look at the data from the Nasdaq Composite Index, which was heavily weighted towards technology stocks. This index peaked at 5,048.62 on March 10, 2000, but by October 9, 2002, it had fallen to 1,114.11, representing a decline of nearly 78%. Now, let's delve into specific examples of companies that were significantly impacted during this period. One of the most well-known cases is Pets.com. This e-commerce company, heavily promoted during the dot-com era, went public in February 2000. Despite having a catchy mascot and significant brand recognition, the company was unable to achieve profitability and ceased operations by November 2000. Another key example is WorldCom. This telecommunications giant was embroiled in an accounting scandal that ultimately led to its bankruptcy in July 2002. The scandal, which involved the company inflating its assets by around $11 billion, not only contributed to the market downturn, but also led to one of the largest bankruptcies in U.S. history. The stock market downturn of 2002 also had broader economic implications. It led to significant economic contraction and contributed to a mild recession in the early 2000s. The U.S. GDP growth rate, for example, slowed from 4.1% in 2000 to 1% in 2001, and then further contracted in 2002. Let's consider some of the key reasons behind this market downturn. At the core were excessively high valuations, poor earning realities, and failed business models. Additionally, the September 11th terrorist attacks in 2001 exacerbated investor pessimism, leading to further market decline. Now, let's answer some common questions about the stock market downturn of 2002. Question: how long did it take for the Nasdaq Composite Index to recover to its pre-downturn level? Answer: it took nearly 15 years for the Nasdaq Composite Index to recover to its March 2000 peak. The index did not close above 5,048.62 until April 2015. Question: what were some of the regulatory changes that occurred in response to the downturn? Answer: in response to the downturn and associated corporate scandals, the Sarbanes-Oxley Act was passed in 2002, which aimed to improve corporate governance and accountability. One of the enduring lessons from the stock market downturn of 2002 is the importance of diversified investment portfolios. Investors heavily invested in technology stocks experienced severe losses, whereas those with diversified portfolios were better able to weather the downturn. To illustrate the value of diversification, consider an investor with a 100% allocation in tech stocks losing 70% versus an investor with a diversified portfolio, of which only 25% was in tech stocks. If the diversified portfolio experienced a 50% loss in tech, the overall portfolio loss would be significantly reduced. In conclusion, the stock market downturn of 2002 serves as a stark reminder of the risks associated with overvaluation, speculative bubbles, and lack of diversification. By studying these events, investors can make more informed decisions and build more resilient portfolios. Thank you for watching our detailed analysis of the stock market downturn of 2002. Don't forget to like, subscribe, and share for more insightful financial tutorials. Leave any questions you have in the comments below.